We are not financial professionals, and this podcast is designed for entertainment purposes only. We are regular folks who do research and present opinions to an audience in a fun way. Our opinions should not be construed with the views of any organizations we may be affiliated with. This podcast does not represent the thoughts, intentions, plans, strategies of our employers. It only represents the opinions of the authors. If you need specific guidance on your own financial situation, please consult a financial fiduciary professional. If you haven't heard about Anchor, it's the easiest way to make a podcast. Let me explain. It's free. There's creation tools that allow you to record and edit your podcast right from your phone or computer. Anchor will distribute your podcast for you so it can be heard on Spotify, Apple Podcasts, and many more. You can make money from your podcast with no minimum listenership. It's everything you need to make a podcast in one place. Download the free Anchor app or go to anchor.fm to get started. That's anchor.fm to get started.
Jerry, happy Sunday. How you doing?
Hey, man. How are you doing, Greg?
Good. Well, welcome everybody to the third podcast for the Money Vikings. Jerry, I was thinking today, this is like when we used to go to Longhorns, and I really look forward to it.
Yeah, just opened up my beer right now.
Yes. Okay, I like that. Yeah. So those of you who don't know, we used to go to this kind of like dive bar restaurant place that had a John Wayne room, and that's where we would strategize investing and personal finance ideas. And this is our new way of doing it during COVID. So
yes, I know. I can't wait to go back there, and it'll be fun once we can go back there. If they even still have a John Wayne room. Yes,
I that cannot go away. People, we'll have to put pictures of that up.
Yeah.
At some point on the blog. So, well, hey, let's jump into it because we have a lot. We put together these show notes, all these things we want to talk about, and during the week, like so many things come up. So there's like a lot to unpack tonight, right?
Definitely.
Yeah, and it goes fast. So, tonight, it was big week in the market. The FANG stocks, right? Apple and Amazon and Facebook and all those appear to be dominating, right? That continues to happen. But there's this weird thing, Jerry, because there's all this from what I'm reading, also there's all this underlying kind of weakness in the in the economy, right? There's all these sort of underlying currents of risk.
Yeah.
Right.
Yeah.
Are you reading the same thing?
I am. I mean, from the perspective I'm seeing it is that these FANG stocks are making up a huge market cap weighting of the S&P 500 as we know it. So, as we see the market continue to go up and up, it really is driven by these 4 or 5 dominating stocks. And that's great that, they're booking so much revenue and expanding and hiring. But there are a lot of other stocks in the S&P 500, and they're small caps, and they're not as well. So it's going to be interesting to see how this plays out.
Yeah, I mean, so it's one of the things as an investor you kind of are looking at, and a lot of folks out there, if you have 401ks or mutual funds, you probably have exposure to these, to the Amazons and the Apples and the Facebooks of the world. But time will tell. But speaking of 401ks, we're going to talk about a couple things this evening. We're going to talk about a concept that Jerry and I came up with called the investing trifecta. And it's a way to triple net worth in like 7 years or so. And then we were going to talk about what Jerry's been doing with futures trading, which is I'm fascinated to hear about. So which one should we start with?
Why don't we start with the investing trifecta?
Okay, let's do it. Okay, so I'll launch it, and feel free to dive in if you want. But the whole concept behind this is, to build wealth, it's like a multi-pronged approach, right? You've got to do all these things to build wealth and get yourself, healthy healthy and strong from a financial perspective, right? You got to,
Yep.
right? You got to watch
Absolutely.
right. You got to watch your budget. You got to have, you got to have income coming in. You got to invest properly and all this stuff. So the whole thing with the investing trifecta is to take these three sort of concepts and like have them all work together to drive your net worth up. And so the first one, maybe you want to introduce this one, but the first one is dollar cost averaging. Do you want to talk to that one and how you've used that?
Sure. I mean, it's kind of a interesting way to invest. It's pretty, you don't need to put a lot of thought into it. And that's kind of the beauty of it. It's very simple. And before we even go to that, I should say, the first thing that you should do to triple your net worth, besides the three things we're going to go through, is to save some money and invest. Mm-hmm. Right. Mm-hmm. You can't do any of this dollar cost averaging unless you're putting money away each month. So that's probably one of the first keys. And you want to try and automate that. But the dollar cost averaging idea is that every single month you automatically put money in an investment of your choice. And whether or not the market is up or down, you still purchase. So if the market is down really low, of course, you're concerned that the value of your portfolio is going down or the value of that index fund is going down. However, Greg and I are in this for the long term. So if the index has gone down by a lot, you're actually purchasing at very cheap, low cost times. And it won't be like that forever. And it will come back up. And so what dollar cost averaging is doing is basically averaging out and lowering the cost of the investments that you make every single week, month, or year into said index fund. So you're basically buying it at a cheaper price than what the market is probably at any given time.
That was awesome. Doesn't it make you cheer like down market days? You know what I mean?
It does. It does.
Right.
I mean, at the very least, I know that I'll go back in time and look at my 401k investments and transaction dates, and I'll see, I'm able to pick up more shares of, I have an S&P 500 index fund in my 401k. And I'm able to pick up more shares of that when back in March, I was getting a lot more shares than I am today.
So most of you out there, if you do have access to a 401k or an IRA self-directed, where you're putting, let's say you're putting $300 a month in your Vanguard IRA or your Fidelity or Schwab or whatever you use, if you have that automated, you're automatically doing this because, like Jerry said, on down market days, you're buying more shares. And so I don't know. I've just found it really handy because during things like the Great Recession that we lived through, Jerry and I are Gen Xers. So we've lived through, like, I was joking the other day, Jerry, with my wife about how, not joking, but that's the wrong word. We were talking about all the like things we've gone through as Gen Xers, like, the .com bust was like kind of at the beginning of our careers, right?
Mm-hmm,
right.
Mm-hmm.
And then we had 9/11. Then we had the Great Recession. Now we're doing this pandemic. So it's been like there's more really huge disruptions in our, you know what I mean, in our working careers.
We're pretty messed up.
we're totally screwed up. Yeah, we're totally screwed up. I mean, drink another beer, man.
All right.
But that's the whole, and that's another whole point of us like coming together and like working together, having our blog is like we're trying to help each other, help everybody and each other in order to like navigate what is not always a very easy environment, right? To like get ahead, to say the least.
Right. This is a very simple one. I mean, if you have a full-time job that offers a 401k, you turn it on and you pick some funds. It could be one fund, it could be multiple funds, whatever you're comfortable with. We could talk about diversification in another episode, but just turn it on and set it and forget it. And let dollar cost averaging do its thing for you. You don't have to really think. And in 5 or 10 years, you'll look back, if you don't check it every single hour like I do, you'll look back on the account value and hopefully you'll be pleasantly surprised.
So we did say it's a trifecta. So that's the first one. So the second thing is, okay, so this is a little bit tricky because not everybody has this luxury, and I understand that. And especially in this environment we're in now with the COVID thing, which is getting pretty rough for people, and it's really sad. But if you have a 401k match, that's the second thing that you're going to want to harness to improve your net worth. And so I actually have some statistics here. And I don't know, so these aren't, I got to get these updated for COVID, but when we wrote our article about this, 79% of Americans, let's see, who get the choice to fund a 401k, it said only 41% opt to participate. So that's pretty disturbing right off the bat. A lot of people aren't participating. And then it said of that, only 32%, let's see, 32% of the total workforce has a 401k. So that's pretty low. And I can imagine, don't you? I can imagine that's lower now, right? With the pandemic.
Yeah.
So, you know, I realize that, you know, not everybody has this, but if you don't, I mean, what I would do if I didn't have it is I did this when I didn't have this at a job. I opened a Vanguard account many years ago and just basically had a certain amount taken out and put in, you know, every month. And that just depends on what you can afford. But the idea is if you have access to a great tool like this for wealth building, you know, take advantage of it, and especially a match, because like we've always talked about, that's like free money. That's 100% return on your money. You'll probably never get actually 100% return. So if you are lucky enough, like count your blessings, and hopefully that improves for people. And then the third one we talk about, and I don't know if you want to talk about it, Jerry, or commenting on it, but we talk about compound interest, which a lot of people, you know, don't quite understand, but it's there's a famous quote, and I think it's true. I think Einstein said it was like one of the wonders of you know math genius, right? He said it was like one of the wonders of math, like it was like this whole concept of compounding. And I'll try to start by describing it, and then maybe you can do it more eloquently. But basically, it means, so if you have $1 that you have invested, right, and let's say that investment becomes $2, the basic concept is then both of those dollars are spinning off interest, and it just sort of compounds. It continues over time. I think a lot of this gets really ramped up when you have like dividend reinvestment plans, and you start like, you know, you're having that investment reinvest in itself. And then it's, you know, the power of compounding, and Warren Buffett always talks about it too. But I don't know. Do you have another way of describing it that's maybe, I don't know, maybe a little better?
The best way that I've heard it described is that every dollar is kind of a little worker bee, and these dollars that you reinvest kind of go back into your investments and work for you, and you know, they help increase the total amount of return that you're getting. If you just take the money out and don't reinvest it and, you know, go buy a new iPhone with it, that's fine, and that might be your choice. But long term, the compound interest is going to grow dramatically, and it's one of the trifectas for growing your net worth quickly. You really
That's such
want
a
to
great,
make sure
that man, you hit you it's baseball season and you hit it out of the park. I love that. That is so good. Yeah, like every dollar is like an employee that's working, you know, for you, or a little worker bee that can go out and like create value over time.
The trick right now is really to find investments that provide some yield, because as we know, the treasury yields are very low right now. CDs are insanely low. They're not paying anything. So and dividends are being kind of pulled away. So unless you're in a dividend aristocrat fund, or a stock that is increasing or at least trying to stay the same, that is one of the tricks right now of the current COVID, is just to try and continue to find investments that are paying dividends and yield.
Yeah, it's interesting you bring that. Yeah, because a lot of these, I've noticed a lot of these FANG stocks don't. I mean, you get like I kind of wish Amazon did, but they suck all those profits back and do whatever they do with them, right? And Apple pays a small one. It's the what?
Jim Cramer calls Amazon the Death Star, and it just keeps growing bigger and bigger and taking over other things. I thought that was
I mean,
funny.
I was thinking a lot about Amazon this week because of those, those congressional hearings where all the big tech titans are up there
Yep.
on the screen. Yeah. And you just, you look at these guys and these companies and they pretty much, I mean, they rule the world. I mean, every purchase, every click, I mean, is, I mean, our blog, we have Google AdSense on our blog.
Yeah. Yeah.
Amazon, I mean, talk about really well positioned for a pandemic. We've got a lot of Amazon boxes. We have a continual flow of Amazon boxes
Everyone
and
does.
grocery deliveries. Yes. I mean,
Everyone does. I mean, they are making out like bandits right now with everybody ordering stuff and being home. And I mean, it's great they're there, but they're doing really well right now with the with the whole COVID thing. Everybody's working from home and ordering things, and it's just
my recycling bin cannot keep up. I can't keep up. The recycling bin fills up basically within 3 hours of when it gets emptied. So it's oh man, it's a weird time.
So Greg, on the investment trifecta, can I go back to the 401k match a little bit and talk about a personal story?
Yeah, please.
So my company, and I'm not going to reveal where I work right now, but my company did take away the 401k match, which was unfortunate. It's kind of like a pay cut in many ways. So what I did, my wife and I talked over kind of what we were putting away in the 401k, and I had calculated down to the penny exactly how much I needed, like what percentage I needed to pull out of my gross income to allocate to the 401k, accounting for the match, so I'd get to the max amount by the end of the year. And when the company pulled the match, which hopefully they say they're going to return to next year, I really hope that's true, and I will give them the benefit of the doubt. But I increased my my percentage, and it's not the max, unfortunately, because we can't swing that. But we did increase so we can get additional tax savings and sort of simulate getting a match, except it's not a match. It's my own income. But it's just something to kind of keep an eye on. If your company does do this, you may want to kind of reevaluate how much you're socking away. And if you have the ability to increase the percentage, that's something I would highly recommend you take a look at.
That's a really interesting story. And I recall, I think you had mentioned that to me a week or so ago. And, in a way, to be honest, I even feel bad just kind of talking about it right now because of what's going on in the world. I mean, you see you know what I mean? You see the unemployment figures.
We're lucky to have jobs. We're lucky to have 401ks.
I mean, so I hope people get that. I totally realize that, some of this stuff, the bigger picture point is, that, as I said, we now have gone through 4 major disruptions in our working careers, right? And these are existential things. They happen. And so I think the idea is, throw everything you can at becoming some level of financial independent or some level of financial health. And I'm not saying that's easy. It's not. I mean, in my book, I haven't seen a lot of get rich quick. I guess that happens, but I haven't seen it. What I have seen is people that spend many, many years, many decades, developing the skill sets and the discipline and the emotional control to, create a nice, secure financial life for themselves. And it takes a lot. This pandemic, like all things, will shake out and will affect people. I think like you and I think we're very much affected. I know I was very much affected by the Great Recession, and I kind of feel like we're living through something like that again.
No, I agree.
For those of you that, the listeners out there. So I was actually during the Great Recession, right before it, I was trying to make a bit of a transition. I'm an artiste and a painter and illustrator in my spare time, but I was trying to make a transition into kind of an illustration or an artistic career. And I was putting some artwork in galleries and was having a little bit of beginning success with all that. I was finishing up an art degree, and the Great Recession hit. So that's another podcast. So I'll share that story some other time. But you know, it wasn't the greatest time to go into an arts career during the Great Recession. Hey, let's transition over to something that I really know nothing about, but you're learning about, futures trading. Do you want to tell us about what you're doing?
Yeah, sure. So one of the things I do first before kind of going into all the details is looking up what a futures contract is on Investopedia, one of my favorite websites for just kind of getting straight on the financial terms. So what is a futures contract? I'm reading this directly from Investopedia. A futures contract is a legal agreement to buy or sell a particular commodity, asset, or security at a predetermined price at a specified time in the future. So it sounds like a lot of mumbo jumbo, but really what it is it's a tool for people to manage risk for their companies or their endeavors. If you think about farmers who are, is that Joey in the background?
Yeah, I'm sorry. That's my dog, everybody. You know, it's pandemic times. We're doing everything from home.
We'll just edit Joey out in the
That's post. Okay. Keep him in. It's fun. But it makes you lose your train of thought on futures. Sorry.
Not at all. No, I was saying that farmers basically can't predict the weather. And so if they're growing corn every year, every season, there's some sort of predictable cycle every year that they go through, but sometimes there's droughts, sometimes there's lots of rain, sometimes it's just average, and so they don't know exactly how that's going to work out, and they still have obligations and they have businesses to run, and they don't want to have that huge losses. I mean, I'm sure they'll be happy to take the huge profits if it's an extremely rainy season for these crops. But definitely what they do is they hedge, and so futures were created so farmers and people in other types of businesses with commodities like oil and whatnot could in advance smooth out their revenue and their profit and loss, so it would be a little bit more predictable what they would make by the end of the year. Airlines also another good example when explaining futures to people. They don't know the price of gas and oil, if it's going to go up or down, but they have businesses to run. And so one of the things they'll do is they'll hedge, and they'll be able to kind of keep an eye on what the future cost of gas or oil is going to be. And they'll put these transactions in place. Either they'll go long or they'll go short based on what they think is going to happen. So they can kind of keep an average cost of what the fuel costs are moving forward. And that's kind of where they came from, I think back in the 1800s when they started. What do you think of that, Greg?
That's wild. And that's a really good description. So and what I think is really cool, Jerry, is that we're doing it's really cool to kind of do this thing because you've got like the investing trifecta, which is like, hey, that's like a really straightforward way that you could invest, blah, blah. But then you've got this whole thing. If you want to do more advanced stuff like the futures trading, I think it's really fascinating. I mean, so can you walk me through kind of like one you've done and maybe again, break it down like I call it Barney style, like,
Barney.
Like very basic.
I love you. You love me.
We used to play that for our daughters.
I'll edit that out, definitely. Okay. So, yeah, there's when people first think about futures, they think about commodities maybe or oil, but there's also index-based futures, which is our fun friend, the SPY or the S&P 500. You can basically go long or go short. And so the problem with futures though, is that they're really not initially they weren't designed for retail investors. They take a lot of capital to really leverage them effectively. But one of the things that I've been doing is playing around with Tastyworks, and they've launched a new small exchange, and they have 3 or 4 different products right now that allow the little guy to dabble in these futures.
That's cool.
Yeah, because with futures, one of the issues is that every single tick, like if you go from 5.1 to 5.2, that sounds like a very small amount of money, but really it could be $500 per tick or something like that. So, and the Chicago Mercantile Exchange has created a smaller product called the micros. So they basically reduced the size of the futures from thousands of dollars to hundreds of dollars. So one tick is now closer to in some products it can be as low as $1 or $1.25. Other products it could be $5.
Let me ask you a question. Do you know then going into it your max loss and max profit? Do you have a sense of that?
I don't have a max profit per se. I should have a better trading plan, but what I do like to do is go in and have a mental stop at a given point. Right now with these futures, my stop losses are anywhere from $20 to $200 depending on the situation. Whether I'm in it for a few minutes or I'm in it for hours or days, that really depends. I'll give myself a little more leeway.
Okay.
One of the futures that I've been experimenting with is it's called the Small 75. And what the small exchange folks have done is they've taken 75 different stocks, all household names that you would know about, but they're looking at the most volatile stocks out there on purpose because they want to create tradable ranges that people can go in. And when something goes down a lot, the idea is that it will very quickly turn around and go back up. And if it's something is really up high, it will probably turn around and go back down very low. That's kind of like a mean reversion style of trading where you buy something where you feel like it's overextended, oversold, or overbought, and you look at your technical indicators or whatever sentiment indicators that you prefer, and you enter the trade hoping that it kind of reverts back to where it should be, kind of the averages. It'll revert back to where the market naturally thinks it should be at a given time. So it's a very interesting product, and it can be used for 2 different things. One is hedging, as I was saying earlier, for the corn and gasoline examples for farmers and airlines, but it can also be used as speculating. If you know that the price of corn is going to go up, because every year in July and August, the prices of corn for the past 30 years have gone up, you might want to go long corn and buy a small future. It's called the /XCUO. Right now it's trading for 315.875. And if you want to hang on to that and you think the corn's going to go up in August, you could purchase that, sit on that, and wait. Each tick is worth $1.25. If you think there's drought coming, and you think this year is going to be different, you could sell those and you could profit from it going down.
Do you have a sense of percentages, or is it more of is it like your gut or reading in the paper? Or...
Yeah, well, you can go to there are tons of agricultural websites that have data about the weather forecast, and there's the USDA reports that come out every few months or weeks that explain kind of how the planting's been going, and there's more data than you can possibly imagine out there on every aspect of every commodity. I tried to go long on corn thinking it would come back up. But on the 28th of July, I decided I had lost enough money. It was $85, so I was long corn, and it was just going down, down, down. So it hit kind of my mental stop, and I got out of that trade. And I've been watching it because I'm waiting for it to kind of show a little bit of. I'm waiting for it to kind of turn around a little bit, and I think it will come back up eventually. But right now is not the time. The other transactions I've been doing, I've been playing with the U.S. dollar, and I've been playing with currencies. And so the U.S. dollar right now has been going down for a long time and weakening. And there's a lot of theories around that, stimulus bills and global events and whatnot. But as the dollar tends to go down, other currencies that are compared to the dollar, like the Aussie dollar, Australian dollar, or the euro, will go up. So
and we're printing a lot of dollars, right?
So we are. So that makes them worth a lot less.
Yeah.
And you need more of those dollars to purchase gold and silver and other commodities. So it's fascinating how all this stuff is interrelated. The other day I had my screen set up, and I put a euro and I put a US dollar index on the same daily chart, and they're just completely inverse of each other. And so as one goes up, the other goes down. As one goes down, the other goes up.
I just do not see any normal in sight until the virus is under control.
Yeah.
I think that's just the reality of everything. But time will tell. 150 vaccine candidates out there right now. So we'll see how it goes. But that's amazing. In one episode, we went from dollar cost averaging, investing trifecta to futures. I think it's pretty cool, actually. That's pretty cool.
It is. It's sort of like going from like MC Hammer to Mozart in the same musical playlist here. It's completely different things.
That's a great analogy. That is a great analogy. But you know what? That's the way it was when we'd go to Longhorns, and we would talk about all kinds of crazy stuff. But it was all that's half the battle, I think, and again, that's why we started writing this blog. It was to learn ourselves and to teach others, because again, there's so much to learn about investing and managing our money and personal finances that people are never taught. Right. And never. I mean, and so I don't know. We're just, got to get the word out. People,
and that's the beauty of these. There's paper trading. There are lots of different ways to get involved with futures and trying things out. Most sites, I think even Investopedia and others, will let you paper trade, which is you don't lose any money, and you can just try buying and selling futures and see how you do.
Well, I'm curious to see how that's going to shape up.
But I do like the small exchange, because really every single tick is $1, which is really inexpensive. And I paid the $100 fee to get their data feeds for life. So that makes the transactions really cheap as well, kind of for the rest of my life to be able to trade these things. What they need is more users, more volume, more liquidity, and then I think they're going to be pretty cool. I think they're going to grow fast, and they're going to be pretty cool products. I've been keeping track. One of the key things I like to do is just keep track of all my trades, all my metrics. And for the month of July, humble bragging here, but I had 12 wins and 5 losses. So 17 trades in total. 71% of them were winners and 29% were losers. And so the average, I basically made $149. And that works out to me winning $403 and losing $254.
If I could add though, people can see your trades on our blog, The Money Vikings. So go to themoneyvikings.net, because you put a lot of your trades you put up there.
Yeah, I do. When I was on vacation, I was doing it daily, and now not so much. But I will try to put a few more in that are interesting, not just the winning ones, but also losing ones.
Yeah, it's awesome. So, man, the time goes fast, Jerry.
It does. It does.
Well, till next week, I guess. Let's see what happens, right?
That's right. That's right. Hopefully, it'll be an interesting week. I will say that I'm looking at some earnings trades for next week too, and just be aware we're still right in the middle of earnings season, and there's a lot of really interesting companies that are reporting. A couple to highlight: Beyond Meat, Twilio, Roku, Regeneron, Papa John's, Dropbox, Datadog, Noble Energy, Kronos. So keep an eye on things. Basically, for the equities that you do have in your portfolio, make sure you're aware if they're reporting earnings or not, because those have the tendency to make the stocks go up or down quite a bit. And if you're doing options trading on them, enjoy the fun that the iron condors or short strangles will bring you with these things, because you can have a lot of interesting outcomes from this week once the week's over. Oh, and Moderna too, one of our favorites.
Oh yeah, there you go.
Square and CVS. So I'll leave it at that.
In the vaccine race.
Yeah.
Well, you know what? I really look forward to talking with you every week. This is awesome.
Me too.
Yeah. And thank you to our, I think we have like 10 listeners now, by the way. I think we added 2.
Yeah.
So we have like 10 listeners now. So thank you to all of you, to all 10 of you. And have a great week. And we'll talk next week.
Sounds good, man. Take care.
Okay. See you, Jerry.
Bye.
Bye.